Let's go.
All right. James and Full Capital here. James Wilson streaming in as well. So appreciate everyone jumping on. I think, we had a couple things on the radar. The main thing is going to really be DFW deals that are on the market. But what I wanted to start with is just sort of last week, we had some reverberations, I guess, earthquake in the
Some
multifamily.
headlines, breaking
Yeah,
news.
some breaking news. So we'll start with the breaking news, and then we'll jump into some of these deals. So let me see if I'll share my screen, and then we'll start going here with some of the latest. All right, let's try this guy.
So we had some viral threads on Twitter this past week.
Yeah, Twitter and
Facebook a little bit.
Facebook was blowing up out there. So before we jump into this slide, let's jump into. All right, can you see that? All right.
Yep.
All right. So yeah. So shout out to John Winnick. I saw this first from him. I think Barrett Lindbergh posted it up on Twitter. But basically, 4 loans in Houston, 229 million in loans, bridge loans were foreclosed on. I think this was last week, and we're still trying to. This is sort of like after the body's been after someone's been murdered on a crime scene. You're trying to figure out the what happened here. Like X-Files, I've talked to a couple people. BizNow hit it this morning, and this was some of like this large deal, Heights at Post Oak, 940 units. The loan was 47.8. It sold for 46.5, so about $1 million loss. This one was about $5.7 million loss. This is on the loan side, not the equity. All the equity on the common side is gone. This one, Redford Apartment, 68.8 million, sold for 50 million. So that was probably the biggest loss. And then this one, 47, Timber Ridge, 47 for 40. So about $32 million loss on the loan side. So pretty painful for investors out there and for the lender. But it looks like the pref equity has stepped in the shoes of the general partner on this.
The original pref equity on the deal.
Original pref equity. So I think right here, I don't know if you can see it, Fundamental Partners, I believe, was the pref equity. So there was the bridge loan and then the pref equity on top of it, and Fundamental Partners stepped in. And I guess to protect their position, they probably had, 200 million. They probably, most pref guys are putting 10 to 15% of the stack. So they probably have 30 million at risk, right? So the LPs had, the top 15% of the stack. And then the pref probably had the other 10, 15% of the stack. So
what's that, about 70 million in common equity, LP equity?
Common equity, yeah, common equity piece, yeah, at least 30, if not more. So
is that coming back, or is that
the common's gone? Common's gone. Pref is trying to protect their position now. So the pref is sort of reset their basis. I think from what I've seen, Arbor sort of gave them a new loan at sort of a lower basis, and we'll see what happens on that piece.
Didn't it go to the courthouse steps?
Courthouse steps, yeah.
No bidders, what happened there?
I'm not sure. I think on Twitter there was silence when it went out, and most people there probably are looking for single family homes. So to come up with a big number, 200 million, was pretty hard. So they didn't have a cashier's check waiting. So I think it just went back to the lender, and then these guys stepped in probably at some point, so to protect their position. But what are you hearing out there? What's the rumblings out there from your side? I'll try to make this bigger.
Yeah, it's kind of going viral on Twitter. I was watching a lot of the posts and the commentary on it, and someone was saying they have another deal out that they're trying to raise for. I don't know if that was true or not, but there was, I think on multiple threads, not just the one that John shared, but there was multiple other posts that went viral too. So I think it was kind of the bridge shot heard around the world, or at least around the The multifamily nation of sign of distress in multifamily going on right now.
Yeah, so all right, let's just this, whenever I see something like this, it's sort of spurred, all right, what else is out there? So I'm going to leave it on this side so I can still see you a little bit. Can you see the screen okay?
Yeah,
Is it
it's
big enough?
showing
All right,
showing
cool.
nice. Yep.
All right, so this is one of the charts, and I've shown you this chart, but it's in Howard Marks' sort of most important thing. So if you haven't read that book, go out and download that PDF out there. But it basically shows the risk versus return profile, and this is how most people should be thinking about the risk versus return piece between loans. And so, Old Capital's a mortgage broker. And, a lot of times people are like, all right, should I do Fannie Freddie? Should I do non-recourse bridge? So this was an example of a lot of times when people see a return, they think that's like the only number. But it's not just the only number, it's a range of outcomes, right? Like every pro forma that you've ever done is wrong, right? It's going to be up 5% or down 10%, whatever. So to me, if you see a deal, it's Fannie Freddie fixed and it's a 15% IRR, you're going to be in this range, right? It could be 20, it could be 10, right? But as you move up the spectrum, so a lot of people started going Fannie Freddie float, and then, that might be 15% plus or minus 10, right? So it could be a 5% return, it could be a 25% return, just because of the amount of volatility in the floating rate side of the equation. And then non-recourse bridge, not only do you have floating rate, but you also have the term maturity. So that increases your risk even more. And then I would say this is sort of the last deal we saw right
That's the
here.
Houston portfolio right there.
So it had non-recourse bridge. I got that. All right. No interest rate cap. I haven't confirmed that, but that seems to be what people are saying. And then it had pref equity on top of the bridge. So if it hit, it would be a huge return, right? So it might be a 25, 30% return. But then if it doesn't hit, you're down here, right? So your return that you thought was 15 to 20% is zero. So I updated my chart with some of these debt terms for people out there just to give them an idea of what we're seeing. So let's flip to
I
the
think
next.
I've seen that
Yeah.
presentation from you before, and it's a good one to kind of readdress right now while this is going on.
Yeah, I need to reread the book, but if you haven't read that one, then jump in. So all right, next slide. So this is a 10-year treasury. I just pulled it this morning. What's your thoughts on where 10-year is today?
I feel like the 10 years just kind of hovering around that 3.5 mark. It was nice to see it dip down a little bit below. I think it got down to 3.2 something.
Yeah.
And it was looking kind of bright for some refis, but now it's popping back up again. Looks like it's on another trajectory higher, but who knows? I think you were right in the last live or the last webinar about being, prepared for a refi when it's around this level right now, because there's a pretty good rate that you can get, 5.5% Fannie Freddie.
Yeah, I think the last I saw is really like the bands were here.
Mm-hmm.
So around 3, this is where the resistance was for all those stock traders out there. It was sort of the band. It was sort of like 3.4 up to around 4 or 3.9. So it's been trading in this range for the last, let's call it 6-7 months. So it's almost like something's got to break, right? So if it flies below this number, then it might just keep going. Like I've seen reports that the 10-year treasury is going to just not make it. But on the top, it's also going to be, if it breaks through that 4, then you're going to be in trouble. So
kind of my thinking about the 10-year is everyone thinks that there's going to be rate cuts in the near term future, maybe 6-9 months down the road. I don't think we're going to be able to hang out at high interest rates for forever. Maybe I'm wrong, but for what the market's kind of pricing in with the forward curve.
right.
So people might be trying to pile into these treasuries 10 years now while it's 3.5%, 4%. And then when interest rates go back down to 2-1%, these 10-year bonds become more valuable in somebody's portfolio because of the interest rates going down.
Right.
Just a thought.
All right, so 10-year Treasury. Most people who are doing fixed rate right now. This is really the gauge, right? So I'd add probably 200 basis points on top of this to give you an idea when you're out there underwriting. So 5.5 probably is a good number right now. So let's talk about here's the curve. I pulled it this morning. What are your thoughts on the forward curve, James?
I feel like the forward curve changes every week, and it's getting it's getting steeper and steeper down to the zero side, or zero back to down to
Like down here, it's dropping. Yeah,
2%. Yeah, I feel like it's March going to go back down sooner than we think, or at least that's what everybody's placing their bets on. Is that for that to happen?
Yeah, I think the Fed is trying to talk a big game, and I think they got one more hike in them, is what most people are predicting, then a pause, and then we'll see how long they're going to hold. The market down here is really just saying, it's going to hit 5 to 5.25, and just sort of stay there for a little bit. Usually they pause for 6-7 months, but if they can't hold, if something breaks, they're going to just start cutting. So you just have to be in position on this. And once we see that pause, so maybe that June 14th, maybe that'll be our next event, June 15th, just to figure out if we see interest rate caps go down. But since the Fed has just kept cranking along at 25 basis points, we've definitely seen interest rate caps sort of stay high, and they're still pretty expensive right now.
So once that pause hits, those interest rate caps should start going back down, right?
Yeah, usually it's like within 3 months, it usually drops by about 50%. So if you're paying 4% of, let's say the the cost of the cap is 300,000 right now, it should drop by half, a couple months after the pause. So you've got to make it past, they've got to pause, and then you have to make it past that. And then that's when you buy your cap, or wait. I would wait as long as possible at this point. Because I don't think anyone's predicting the cap cost to go up unless we see a ton of volatility. So if there's a ton of volatility, a bunch of banks, then that's when people couldn't even buy caps. Like 2 weeks ago, people were having a hard time buying caps. So yeah, I would say flat to down on this forward curve for a little bit. So that should help most people. But your properties, the reason this is going down is that people are sort of seeing some recession signs, and so it's going to hurt sort of your top line at some of these properties. So it's a combination of better interest rates, but then tougher economic environment. So this was from the Fed. I think at the end of March, it showed just sort of what the loan volume was in March, and pretty much every loan officer was down probably about 25% on their index. And so, it's been pretty tough out there on the bank loan side as well. So, but here's a snapshot. We get asked for this chart a lot from people. So I'll just put this up there in terms of the bank loan, Freddie, SBL, Fannie, and the non-recourse bridge. And so some of these, take a snapshot of this one. And then, maybe comment if you want the deck. We can send out the deck if it's someone said it's a little choppy on the live stream. So we can send out the deck after the call here. All right. So here's my bio page. I think I need to get your bio page on here, James. But there's our contact information. So this is all right. Here's the main event. That was just a little intro. Any other news out there, James, before we jump in here?
I think I was getting some headlines from some people about commercial real estate sales being down 74 to 80%, somewhere in that range. Oh, yeah. And I definitely, we feel that for sure. Business is down quite dramatically, although I think we still did pretty good Q1, all things considering, at Old Capital. So we're still closing deals. I got a couple deals going. You probably got a few deals going as well. So we're plodding along. But yeah, I think that's the big headline, is that sales are down quite a bit. I think second half of the year, we'll start to see that tick up, because this list was pretty much non-existent over the winter, kind of the winter break. I think last year I tracked maybe 200 deals at any given time, that spreadsheet that you see there. So we probably had like 200 deals, and I couldn't even keep up with it on a day-to-day basis. And so it was kind of crazy. And then things slowed down over the winter. We probably saw, maybe there was maybe 5 deals on there, and I didn't even really keep track of them too much because they weren't moving. I think a couple of them might still be on there. But yeah, now we're starting to see activity pick up. We're starting to see more deals come out, and so we're getting the list going back. And this is kind of what we're seeing pricing wise. So yeah, I think we can go over some of these deals today just to see where prices are, see where things sit in the market, and kind of where the cap rates are, so that everybody else can get an idea of, where they should be submitting their offers at.
Yeah, so this usually on sort of what's the deal live. We sort of dig in. We're either on the property or we're interviewing the broker. This one's going to be a little bit more high level. I wanted to give people an idea of where deals are trading in DFW right now, and sort of, so these are the whisper prices. So this is just sort of what the broker is asking out there per unit. And so we're going to start sort of I would say B minus C stuff. So 70 a door to maybe 100. 110 a door, 120 a door. And then as you move into the 80 stuff, you're going to see, 125 to 160 a door. And then you move into some of the newer construction, you're going to see 240 to 250 a door. So, James,
358 a door.
358. That's a big one. That's all 3 beds. So, so let's just kick it off, and I'm just going to pull up a slide, and then maybe we'll just go back and forth and try to discuss these deals a little bit. So this first one, Willows, this one's in Ennis and Corsicana. What's your thoughts on this one, James?
So Ennis and Corsicana is just south of the Metroplex, probably 45 minutes or so?
Oh yeah, southeast. Yep.
Southeast. So not too far away. You could still probably commute to work in DFW if you had to. I think it's a B asset, or one of them is. It could be a package deal, right?
Yeah.
One's 18 units and one's, what's the other?
Like 90 units or so. Yeah, 90 units.
So
yeah.
I think you can buy them individually or you can buy them as a pair. But that's a good, 100 unit deal, pretty close to each other. And that's a good property management that you could get on that deal. So to me, that's like a good first time, someone trying to get into the market, kind of build their resume out. It's a good 80s, mid 80s, mid 90s deal. Probably not going to be a lot of deferred maintenance. Plumbing and electrical will be a little bit better. What do you know about Ennis and Corsicana as a market? I'm not too familiar with the market. Like, how's the tenant base?
Yeah, I mean, it's definitely it's not as, I would say it's a good suburb of DFW. Let me just plug one of these in. Let's go take a look. Let's do a drive-by, Google drive-by of the property here, and just show people where it's at. Let me see if I can switch over to this screen.
Yeah, so the debt on those, you could do, agency, I think 5 million to 6 million, somewhere in there.
Right.
Total leverage, and then probably a bank because it's a smaller deal. 5.6 million with some rehab. Interest rates ranging 7.5% to 9% is what we're seeing right now in bank deals. But a lot of the banks, it seems like they're not going below that 1.25 DSCR right now. So the leverage or the proceeds will be similar to agency, and you're going to get a much better rate with agency.
Right. Yeah. I think on the larger deal, doing probably Fannie or Freddie SBL probably works, and then on the smaller deal, probably a recourse bank loan if you can't combine it. So we did have a question. Maybe James, you can take this guy on Freddie SBL. Can you see that question?
Yeah. Question on Freddie SBL around 1.5 million. If you have 6 to 12 months of a 6-unit management experience, could you qualify for building 24 units without hiring a property management company? Well, I think you could get the loan if you have the net worth and liquidity requirements, because you don't necessarily need that much experience with Freddie SBL. However, I do believe they're going to want some sort of property management to help along, but could be wrong on that one. 24 units and below doesn't really lend itself to, maybe just part-time property management, right?
Yeah, I
What do,
mean,
what do you think on that one?
yeah, I would think on Freddie SBL. Sorry, this is Fannie SBL, so maybe so. Freddie SBL is sort of 1 to 7.5 million. They usually want you to have third-party property management if you don't have a ton of experience. So I'd probably start there. If for some reason you didn't want to have third-party property management, they could maybe do the deal at a higher DSCR. So instead of a 125, maybe do a 140 cover, so lower leverage, 60% levered. And then on this one, my guess is that they would want you to be local. So like, you could drive there in 30 to 45 minutes and be close to the property. So I think if you had sort of local experience plus lower leverage, I think that would work on that deal. So, but yeah, send it in and we can get it submitted up to Freddie SBL and sort of get a hard quote from there. All right, let's jump over this guy. All right, next deal. All right, can you see that? All right.
Yeah, Keys Terrace, 38 units, 1963, C-class property in Dallas.
Okay, so 2.85 is the whisper on this guy. So what is that a door?
That is
About
75 even a door.
75 a door. Okay. What do you know about this property?
I don't know a whole lot about it. I know Multifamily Group has it out right now, and they've been touring the deal.
Okay.
I know 60s deals are a little bit more challenging on the repairs and maintenance CapEx side. So anybody coming into this deal would likely want to, maybe do it twice over, count your numbers, count the budget, and maybe do a little contingency in case there's some cost overruns on the CapEx portion. But, Dallas is always a good market. They give higher proceeds. Freddie SBL might go down to 1.2 cover in
Right.
Dallas. So that Dallas is always a good market to be in.
All right, let's go. All right, let's go to the next guy. So that was 75 a door. All right, Norvell Court, 97 units in Dallas, 95 a door. What are you thinking on this one?
I'm thinking a mid 80s property below 100 a door right now in Dallas. It's got to be a tougher area because normally the 80s deals trade around 130, 140, maybe a little higher. But I mean, on the outside, it looks nice. Is there maybe a low income housing tax credit attached to it? Or
I think this is just a straight up. Yeah, this is a straight market rate deal. Let me try to pull it up maybe on Yardi and see. We're looking on this one. So this one's more in East Dallas. So real quick, see if I can share the screen here.
Or maybe someone's getting a deal.
Yeah, I mean, let me see if I can share that.
Could be price to sell right now,
Yeah, I mean, I think people are trying to get people out there on these deals. So yeah, 97 units. Here's some pictures of the property.
Pool
B
looks
deal,
nice.
2-story B deal. So I pulled the rents on some of these properties, but I mean, this is one thing, a lot of times we look at price per unit, but another thing that you want to look at is, the mix of ones and twos, and then also the square footage, right? So smaller units on this guy, so 605 square feet, and then $1,100 rents, and about 20% of the units are two bedrooms, and 80% are one beds. So
okay, so maybe just the total income of the property might be a little bit lower because of all the one bedrooms.
Yeah, the one beds. And then we can always go into demographics here and see what sort of the median income is, and we'll do this on some properties. We're not going to do it on all of them, but yeah, I mean, it looks like it's in sort of that orange and yellow area, so it's really like 40 to 57,000 in that range.
Is that a 3 mile or 5 mile?
This is block by block. So they look at it block by block. This is census data. So they're looking at it block by block on this one. So
yeah, I think that's a good point to touch on. Somebody asked me a question last week about another deal in Houston,
Right.
and I think we had pulled up something like this and said, maybe the annual median income or AMI is, not as high as some of the other spots. So that's one thing to definitely look for when you're looking at a deal, kind of see what the AMI is, because that basically tells you how much a tenant can afford to pay in rent. So it's a good metric to look at.
You want to take this question from
Yeah,
Brent?
we got another question from Brent.
Yeah.
Thanks for watching, Brent. Can you please elaborate on RUBS opportunity benefits? So RUBS stands for Ratio Utility Billing System. The opportunity would be if a property is not billing back for utilities, you can bill the tenants back and get some of those costs back. Some people like doing an all bills paid. That's where you have a tenant just has one bill and they'll pay all the utilities with their rent, so they don't have to pay a bunch of different bills. So that could be an opportunity if it's an all bills paid property. You could implement RUBS and get some of that income back. I think it just depends on the location as well. Some people like the all bills paid, and there'll be a lot of resistance to do RUBS, but definitely look at where the property lies and how well it's being run. If RUBS aren't being implemented.
So this one, so 9.2 million is the whisper on this guy. So 95 a door. So I'm guessing it could probably go Fannie or Freddie SBL. Freddie SBL usually caps out at 7.5, so you could be right in that range. So Fannie, Freddie SBL would work on this one, and then really, it looks like not only working on the expenses, but then also implementing this RUBS program out there as well. So, all right.
Yeah, how far east is that one?
This one, how far east? Let me
Yeah.
see. I mean, I think it's not out to Mesquite, before Mesquite, so it's inside the loop.
Okay. Yeah, I was just over in East Dallas, and there's a ton of construction, tons of new stuff going up. So I might gentrify out east.
Yeah, this is south of 30. So south of 30 though. So not
Okay.
yeah. So all right, let's go to the next guy. All right. Luna Vista. So this is 236 units on the market. Whisper price is 26 million. So 110 a door right now. Done some nice soccer fields, artificial grass out here. So they're saying tax adjusted is about 5.4%. So what that means is, pro forma expenses, T3 income, they're getting to about 5.4% on this deal right now. So what's your thoughts on Luna Vista?
Luna Vista, Fort Worth. It is, I'm gonna look it up on the map real quick. I know Fort Worth pretty well because I used to live there for a couple years.
Yeah, let me
all right, it's pretty far east, over into Arlington almost.
Yeah, so it's East Fort Worth. I would say this is this area has a good number of apartments surrounding it. They've done about 5 million in capex, it says, in the last 4 or 5 years. So it's similar to that last deal. So it is an 80s deal, but rents around 1,100 as well. But the ratio is a little bit better. So I mean, it looks like there's about 36% 2 beds out here.
Mm-hmm.
And then let's see, we actually sized this deal up, so maybe I'll pull this up.
Year construction 1979.
Yeah, so on that line, everything's an 80s deal, 1979, okay. Close enough. So we had it sized up, Fannie here. Here's some, estimated spreads on the deal, depending on how much, interest only, depending on the term of the loan. So you're anywhere from 5.6 on a 5-year all the way to about 5.3 on a 10-year. So they underwrote the NOI at 1.3. So let's say 1.3, and then they wanted 26 million. So yeah, you're probably about 5% on your cap rate, and then about 5.5 on your interest rate right now. So you're going to want to make sure you have enough upside in the rents to really get you there on this one.
Yeah, I'm pulling up my cheat sheet right now. I have all those deals that we tracked last year archived, so I'm just kind of price comparison into similar area, similar vintage, and price per door last year for that type of asset was 130, north of 130 a door.
Okay.
So I think
It's at
110,
110. Okay. So you're getting
pretty
20% off.
decent discount. Yeah.
Yeah. Yeah. 20% off. All right. So let's flip over. So we did Luna Vista. All right. This is the next one, Northwood. I'm not sure if this one's still on the market. We had it on the sheet, but
yeah, I've been tracking that one for a little bit. Looked like a decent sized deal, 100 unit,
100
C
units,
class,
120 a door.
a good entry property.
Yeah. What are your thoughts on this one? It looks like
Maybe price just a touch high if it's not moving. I feel like that 110, like that other property, it's probably similar, similar vintage,
demographics.
similar demographic, similar annual median income. So, I think maybe if they bring it down just a tad, it might move, and maybe it's already under contract. I don't know, but we have been looking at this one for a while.
Okay.
But it looked pretty solid from the outside. It didn't look like there was a lot of deferred maintenance on it. And that's one thing that I always look for in a C-class property, like see how much extra it's actually going to need in CapEx. If it looks like somebody's been taking care of the property, they've probably been taking care of it throughout the years and it's going to need less deferred maintenance. I think we've been on site to a couple properties that I didn't even know were 70s. They did such a good job. It almost looked like an 80s property. So I definitely look for that on a C class.
All right, let's go. All right, so this one, 2021. Is it Freddie SBL? Yeah, probably Freddie SBL on this guy. I think this is a different Northwood. Is this the same Northwood?
Go up.
100 units?
Yeah.
That's it? All right.
430 Weber. Yeah,
Weber.
that's the right one.
Okay. So let's jump in here. So this is, I'll just pull the demographic. So this is so here's downtown Fort Worth. So sort of northwest Fort Worth there. So looks like similar demographics, sort of in that yellow and orange as the previous deal. So I think we're going to start seeing a trend here. Is depending the price per door and the rents that you're going to be able to get. That's going to give you a little bit of a better idea. All right, let's go to this question. You want to take this one? James, are you there? All right, we might have lost James on the stream here. All right, so on this, why survive to 2025? For a lot of people, that really just means a lot of deals are going to be coming to the market here that maybe aren't doing well, and so the thought is if you can survive to 2025, then we'll be sort of through this down part of the market, and then come up on the other side of it. So. I think that's the answer on survive to 25. And then let's see, Brent, how many deals are coming online in the next 12 to 18 months in DFW? So yeah, I mean, right now we have probably about 30,000. Are you there, James?
Yeah, sorry, I got kicked out.
It's all right, no worries. Brent was just asking how many units are coming online in DFW in the next 12 to 18 months. I would probably put it, DFW is usually right around that 25 to 30,000 in number of units coming online on the A side. So we'll get into some of the A deals on the back half of this, but I think it's usually about 2 to 3% of the total inventory of the MSA. So pretty big number usually. So all right, we'll start going here. Now that we answered a couple of those questions, let's see. All right, so Cedar Trails out in Tyler. So this deal has been on the market probably for about a couple of weeks. It's out sort of east of Dallas, probably about 2 hours. It's around 15 million. So let's see what that is per door. So 15 million Cedar Trails, 125 a door out there in Tyler. And so this deal we actually did the loan for. It has a CMBS loan on it right now. And we got it sized up for Fannie Mae a couple weeks ago. And with the NOI of 890, it's coming in at about $10 million loan right now. And this was sort of before sort of 10-year treasury dropped down a little bit. So you're probably in that 65 to 70% range right now on the leverage on that deal. So I think that deal, if someone's in the Tyler market, that probably makes sense to take a look at that one. It's a good Class B deal out there right now.
Yeah, looks pretty clean. I think you had mentioned Fannie Mae just took Tyler off of the pre-review list, correct?
Yeah, so they're able to go up to just 75% leverage, 125. Or yeah, it can go 80, but most deals, probably 70, 75 would be fabulous for most people right now.
Yeah, so a pre-review market just means that the Fannie Mae delegated underwriting service, DUS, can't just go and lend on that. They need to get approval from higher ups, and they also have to do a little bit higher DSCR, 1.35. So proceeds will be a little bit lower if it was a pre-review market. And so them basically opening it up and saying it's no longer a pre-review market means that they believe in the market. So I think someone asked me that question yesterday. So I feel like if they take it off pre-review, then it's a good sign for the overall market.
Yeah, it's a good sign. There's more financing available, and then just higher leverage available on that market. So, all right, 1809 Cox is the next one. So this one's over in Carrollton, 1963 deal. So the whisper on this guy was 8.8 million. So let's see, that was about 129 a door.
30 a door on a
1963
property.
1963. What are your thoughts on this one while I look it up a little bit?
Looks a little bit high on price, but it does look like they did some work on the outside. So just have to maybe look at the underwriting on it, maybe the NOI.
Okay, so there's I put up the loan assumption structure here.
Okay.
So it has a $5.3 million loan, which is about 62% of the purchase price. It's Freddie Mac. It's fixed at 3.94 until 2030. So you got 7 more years at 3.94, 9 months more of IO. So that's probably what's driving the price a little bit here. It's just you can come in, assume that
Attractive
loan.
assumption, yeah.
Attractive assumption, and then really take it from there. So, I mean, let's see, 5.3, and let's say at 62%. So you're at 8.5 million. Does that jive with our whisper price? 8.5, pretty close.
Pretty close.
8.8, yeah.
8.8.
Yeah. So, I think if there's a lot of risk on financing right now, and so I think this sort of takes some of the risk out. I mean, definitely, we've worked on a lot of loan assumptions with people, just making sure that they, get under contract, get the lender docs going, make sure that not only do you get approved for the loan, but the loan closes on time, right? So on a lot of these deals, you're still having to put up earnest money. You're still having to do all that. But the problem is, and I've seen it on certain cases where the lender does not approve the new buyer. So you've got to make sure your team is set up on the Freddie SBL side or in Fannie side, because it's not a guarantee. It's not a guarantee that your loan's going to be approved out there. And so we work with a lot of people to make sure that their loans their loans get approved. We structure the deal appropriately, all that type of stuff, to make sure that they make it to the other side of the closing table. So
yeah, go see your local mortgage doctor and get a financial checkup.
So let me pull up this one. So this is 1809 Cox.
Make sure you size up.
Yeah, no, I mean, I think it's not only just at the beginning of the deal, but it's also just like making sure that you have your ducks in a row when you submit all your documents to the lender and things like that. So here we go. So 1809 Cox. Here's some
Flat
pictures
roof.
of it. Yeah, it's a little bit of a pitch, I guess, depending on
Depending on the angle you look at.
Yeah, depending on the angle. So, so this is a C and a B, 98% occupied. Let's see, mostly it looks 50-50, ones and twos. The rents here. So we're climbing up the rent ladder. So we're at $1,200 on rents right now. Pretty stable occupancy.
How far back does that occupancy history go?
It's monthly. It jumps up. It's monthly every month.
I mean,
So
how far back?
years.
Year to year?
Yeah, year to year. So
That's a good
it's
metric to look at too.
Yeah, I mean, I would say it's probably 75% correct. So, I mean, I would rather look at rent rolls than just basing it purely on that, because I've seen it both ways. So demographics, median income's about 75,000 is showed in the 3-mile radius. So, I mean, this is sitting right in the middle of North Dallas, right? So that's why, even though it's a little bit older property, you can see that as we move up the ladder, most of this is green or light green. So in that 57 to 70,000 for the census data. So, I mean, as you back up, I mean,
so yeah, that justifies a little bit higher of a price, right? Because people in the area can afford a little bit more rent. So it's not just a 1-for-1, deals. Your deals in the 70s is going to be priced here. Your deals in the 80s is going to be priced here. It's really block by block. And I think we've talked about it before, but Dallas-Fort Worth is a huge market, and then every part of Dallas-Fort Worth has a sub-market, and then there's a sub-pockets in those sub-markets. Definitely knowing where deals lie in the Metroplex is going to be big when you're investing, for sure.
Absolutely. All right. So
maybe even more so in Houston. I don't know Houston that well, but I think you grew up there, right?
Yeah, I grew up in Houston, so we'll maybe do a deep dive on Houston one of these days. But I mean, I think on a lot of these deals, let's say a C deal, what would you say cap rate is on a C deal in DFW right now? Roughly, like 6.5.
Broad stroke, 7? I would say 6%.
Okay, so if you're doing 6%, but then you got this assumption on there. So I think it's probably gonna be inside of that, right?
So you 5.5, 5.
Yeah, 5.5 on it. So, all right.
I think the length of the loan helps that one out a lot too. I mean, if you buy it now and hold it for 5 years, I mean, it's a pretty low risk on that spectrum you had at the beginning.
Go back to the spectrum. Oh man, this guy's quoting. All right, right here.
The spectrum
down here, right?
You're not gonna hit a home run with the 85% bridge and 10% pref and 30x your 100K, but I mean, you're
step into the deal, get
pretty safe.
Have a third party run it, like raise some additional money. Even though you might be putting 30% down, raise an additional 5-10% money. Put in reserves for the rainy day, something's going to break. These properties are old, and just have it ready to go. And so I think that's the right call on that deal. So all right, so we're almost out of. Oh, I guess we're in the 80s now. So we're out of the 60s into the 80s. All right, Lakewood on Henderson. What's your thoughts on this guy?
I drove by the deal. It looked pretty nice. Aesthetically, outside, everything looks fine. I think there's a lot of 1 bedrooms in that one.
Okay.
So kind of like the last one we looked at with a lot of 1 bedrooms. There's maybe a little bit tad high on pricing,
okay.
From what I saw. So I think they could move the deal if they drop it a little bit. I mean, they're at 130 a door. Mid 80s. So you're saying, okay, you get a 60s 130 a door, you got a 80s 130 a door, but I think it comes back to unit mix is another thing you look at, right?
Sure.
So what was the unit mix again on that 1809? It was 2 and 3, some 2s and 3s?
No, it was about 50-50.
50-50
on that one.
Okay.
Yeah, it was about 50-50. I think it was really just the location you're paying for.
Yeah.
So
this one's a little further out, northeast, I believe.
Yeah, this one's just sort of East Dallas. So I mean,
maybe a little bit lower AMI.
Yeah, so you've got 90% ones pretty much on this guy.
Yeah, a lot of ones.
A lot of ones, 4 2-beds. It has that. So this has a good loan on it too, right? So assumable Freddie SBL loan on it. Occupancy has been around 90%. Dipped a little bit. This might have been when someone bought it last.
From the older pictures, it looks like they did some upgrades to it.
Yeah,
quite a bit because when I went out there, it looked a lot nicer than what the pictures on Yardi show there.
Yeah, so I mean, this is just east of 75 right there. Obviously, look at all those apartments along 75. So let me zoom in here a little bit. So I mean, you're sort of in that green. There's some green. There's some. This is when we said East Dallas is sort of block by block. You've got some orange. You got some red. So depending on where you sit in East Dallas, so this is sort of on the border, I would say.
You got some joggers over there, and then you got ankle bracelets on the other side there.
Yeah, there might be some rougher patches in certain areas in East Dallas. So you just got to know what you're getting into there in that space. So, all right, so it's Lakewood. I mean, on that one, it's probably a loan assumption, potentially even a. You could do a new loan, but it's probably a loan assumption at this point for that one. All right, let's go to the next one. All right, Alcove Oaks. So this call for offers is tomorrow. So you better get on it if you're gonna make a run at this guy. So 270 units. What's your thoughts on sort of North Arlington 1980s deal? Let's see the pricing on this guy. 35 million.
It's priced
131 a door.
right where a lot of those kind of 2 to 500 unit deals have been in Arlington and been pricing. So I think it's a pretty competitive price,
right?
Priced appropriately. And then Arlington is, I think it's another block by block type area. Overall, not a bad market. Just, you just got to watch out where, I don't know exactly where that one is, but maybe we can pull it up on Yardi again.
Yeah, pull it up real quick. On this one, I mean, it definitely is sort of North Arlington. Let me pull it up. Sorry, I got the wrong one there. There we go. All right, so here it is on the map. So it's right in the middle of Dallas, north side of 30.
Yeah, you got Six Flags.
This area is a little bit nicer in Arlington, a little bit higher income than some of the other areas. Let me see. So let's drop this down. So I mean, it is a little bit higher income demographic up there compared to maybe sort of South Arlington. So I mean, it does have
looks pretty good. I mean, it looks like a good price for that area for sure.
Yeah.
What's the debt on that one look like?
Right.
That's
funny you should ask. So let's look at the rents real quick. So the rents down here, I know it's a little bit smaller, but let's see. It's about let's see 30, 50. Okay, so it's maybe 60-40. So 60% ones, 40% two beds. Rents are about $1,200 right now. So let's flip over. Let's look at the debt options here. All right, so this is all right. So agency side, you're getting to about 5.5 on the fixed rate right now, and so assuming 35.5, they're getting to, where's the leverage piece? So 55% on agency right now on this deal. So obviously, depending on how much upside you think there is in rents, that's going to drive a little bit of this. I mean, this is sitting at, so their in place that they underwrote to was 1.6 on 35.5. So you're at about a 4.5 cap or so, 4.6. So we'll see if this one trades at that number or goes a little bit higher or lower from there. So,
yeah, I wouldn't count on rents going crazy like they have the last couple of years.
Sure.
Looking at some of those charts, it looks like, all that stimulus money we got over the pandemic kind of dried up. And then now people have adapted to that kind of lifestyle, work from home or not work. And then now they're going to credit cards to kind of maintain that. And I think that's getting tapped out a little bit.
Yeah.
So I don't think rent's going to go skyrocketing in the next year or two.
All right. Let's hit
this. That's just my opinion, but based on the data that I've seen.
All right, let's go. So this one, all right. So this is Rolling. I think this is Rolling Hills Rolling Hills in Lancaster, 53 million. Let's back this up a little bit. 53 million, 138 a door, 1985 in Lancaster. So what are you thinking on this one? So it has a Fannie, 12-year Fannie, 4.1% interest rate, and then potentially a supplemental on top of it as well. So 93% occupied right now.
Lancaster, south.
Yeah.
That's south of Dallas, right?
South of Dallas, yep.
But not South Dallas.
Yeah, so a little bit, yeah. So
just outside of 20.
Yeah, so pretty far, probably 30 minutes southeast. So let me pull it up. I'll pull it up on Yardi and just take a look at what we're looking at here. So it has a Fannie loan on there at 4.1, so that helps a lot.
Shows you that they believe in the property.
Oh yeah,
they're willing to loan on it.
Yeah, well, I mean, they're not only willing to loan on it. I mean, they've it's 384 units. They gave it a C+ on Yardi. So I mean,
it looks pretty nice.
Standard 80s deal. So I mean, 52% 2 beds, 4% 3 beds. So we see the rents coming up. So rents are about $1,300 right now. Has that Fannie loan on there at 4.11%, 12 years. And then let's go down to the location.
What was the loan amount on it?
Loan amount is 27.6. So what was the whisper again? Back to the whisper. 53
million.
Yeah, so 27.6 over 53. So that's about 52% on the original loan, but then you can do a supplemental up on this one up to 130 cover. So my guess, they'll probably get up to about 65. So you might get another 10% in loan proceeds right there on the supplemental.
Yeah, that's a pretty big raise.
Yeah, it's a pretty big raise right now, right? In today's market. So yeah, I mean, someone's got to be confident to take that deal down right now. All right, so it's a pretty big deal.
A good 1031 candidate.
It's a big 1031. All right, let's hit this next one. The Monet. So this is in sort of South Dallas near I-20, 256 units. Let's see what the rent or the pricing on this one. So this one is 36 million, 140 a door, 1980s. Let's jump down here. What do you know about this deal?
I was actually trying to work this deal off market a little bit before it came out. Okay. Someone was trying to buy it 1031 all cash. Farmer out of North Carolina, but didn't go through. I thought the deal looked pretty clean. The person operating the deal did a good job of fixing it up and keeping operations going. I mean, it's a nice mid-80s big deal in Dallas. I think it's a good deal overall. Without looking at the pricing or the agency quotes too much.
Yeah, I mean, I think this one's going to size well. Let's just pull it up here. All right.
It's on Investor Drive.
Yeah, so it's it sits off of 67 and 20 over here. I think they're sort of redoing this mall over here as well. So good size deal, 256 units in this pocket down here.
Yeah, pretty well located right there.
All right, let's flip over to the back to the chart here. All right. All right, next deal. So that was 140 a door. All right, this one moving up the scale here, Heights of Benbrook. So this is sort of south west Fort Worth, suburb of Fort Worth.
Benbrook's a good area. It's just southeast of TCU. Has a lot of good single family and neighborhoods in that area. and they're definitely building a lot. And that it's a nicer pocket in Fort Worth for sure.
Yeah, so this one has assumable debt as well. So it has a 3.8% fixed, IO for another 18 months or so. That seems to be like the trigger point. People don't want to start amortizing any of these deals. So 322 units. So let's see, this one, they want 155 a door out there.
Mm-hmm.
So B deal, 155 a door. Heights have been broke. All right. I mean, so let's see. Let's pull up the loan real quick. Heights have been broke. Plug it in real quick. All right, here we go.
50 million Whisper.
50 million's on the Whisper. Okay.
So 155 a door for a newer property.
1980s, yeah.
Some of it was 2003.
Phase 2, yeah. So James, tell people what the difference in 1980s and 2003 is.
All right, so 1980s we've got 8-foot ceilings. 2003 probably got 9 or 10-foot ceilings. Could have individual washer and dryer in the 80s potentially. Definitely will in newer product. Same with individual water heaters. You could have likely in the 80s you're gonna have individual. You're probably not gonna have a boiler, but definitely more efficient on the newer stuff. Parking lot you could have paved in the 80s. Definitely will have concrete on the new construction. I'm trying to think of anything else that sticks out. But yeah, just less maintenance issues overall. A little bit bigger rooms. You could have better parking. You could have covered parking in 2000s.
Yeah.
Parking garages or multi-level parking. Maybe a little bit better amenities, nicer pool, nicer gym.
Yeah, this is sort of, so it sits, let me take this layer off. So it sits sort of southwest Fort Worth. So here's sort of Chisholm Trail out there. So you're still pretty close. I mean, you hop on I-20 to get to Chisholm Trail, get downtown pretty easily. And then your demographics are pretty strong household income out there. And then you can step into this loan that's about, I wonder if there's supplemental. So probably take a look at the supplemental, see if you can get supplemental on this guy. So it has a 25.7. You said it was 50 million?
50 million, yeah.
Yeah, so you're at 51% right now. Maybe try to get a little bit of a supplemental on that one to see if you can improve it, and then but overall pretty strong deal.
So sticking on 80s versus 2000s, what are some stuff that you look for, underwriting wise when you're looking at the T12?
Underwriting wise, it's not too different. 80s and 2000. The main thing in 2000s is that pretty much everything in 2000s went to 9-foot ceilings, and everything has washer dryer connections in the 2000s. And then a lot of the 2000s have sprinklers. So they went to sprinklers. They went to 3 stories. They went to washer dryer connections, and a lot of them they went to even larger floor plans. So
sprinklers inside the building.
Sprinklers inside the building on a lot of them. Yeah. So I mean, if
I'm looking at a sprinkler right now in my apartment. Must be in 2000s.
Yeah. So I mean, if you look at this unit mix, all right. So we were talking about bigger units, right? So phase 1, it was about 650. This one goes to 672. Phase 2 over here, they did some larger units. I'm not seeing I guess they are getting a price difference between phase 1 and phase 2. So it'll be interesting to dig into this one a little bit. I'm not sure when the call for offers is on this one, but at least the biggest challenge probably with this one is you got to go out and raise. Let's say you want 5,000 a door in rehab, right? So you got to go out and raise an additional 1.5 million on this deal for capex.
No capex from Fannie.
Well, Fannie's not going to give you any capex, so not until the debt service coverage gets a little bit higher. So you're going to have to go do a loan at 25.7, assume that loan, and then maybe put on a supplemental. But overall, it seems like a good deal. So, all right, let's go back to this guy.
I think Brent's got another question.
Oh yeah, go ahead. Pop it up there.
Do you think any rent increases? Do you really think there will be any rent increases even in good markets? I think if there's a good market, like maybe Frisco, somewhere up in that area where there's a lot of people moving in and there's a lot of nice stuff, I think you could get a little rent increase, but it also probably depends on how much new product is coming online.
Yeah, I think your new product is gonna constrain a lot of the. So yeah, if you're getting a ton of Class A stuff, I think the rent bumps are really going to be still in that B space. The C space is probably going to be constrained a little bit just based off of incomes of what people have and their jobs, things like that. But the B space,
no new B stuff coming online this year.
No B stuff. You got to build it and own it for 30 years, right? So, I think most of it's going to be on trade outs of these deals and sort of just getting in position to buy these deals at the right price and then just sort of work from there. So, all right.
Another question from Brian Bell.
All right, Brian.
What is upgraded in a 5,000 rehab for a unit? Just carpet and paint? These days, maybe it's getting a little bit more expensive. 5K a unit's kind of a benchmark, I think, that we use on a lot of deals.
Right.
But some of the nicer upgrades that I've seen, probably, between 600 to 800 square feet, bringing it up to kind of premium, will take a lot more. So I think it just depends on when you get into the deal and you need to see what actually needs to be done. I mean, if the cabinets are good, if the appliances are good, maybe you just need to do, some new flooring or some paint or maybe like some fixtures or some lighting. Just depends on what kind of upgrade package you're looking at. But if you're looking at a complete renovation of a unit, you're north of 10,000.
Yeah, I think we're seeing 10 to 15 on sort of a full upgrade, and then the 5,000 a door is probably just like a partial. So maybe appliances are already done, cabinets you just paint the fronts, and then really just doing hard surface flooring and maybe some painting on the upgrade to differentiate it from just sort of your classic almond colored appliances out there. All right. So let's keep going. So we're almost to the 90s. I promise we're almost to the 90s. So let's hit. All right. Lexington, 164 units.
We're at an hour. Are we going to keep going?
I think, I'm going to keep going, man.
All right, let's keep going.
I think we got to make it to Class A, right? So this is like the progression of every multifamily investor. They start with like the C stuff, then move to the Bs, and then move to the A. So we're not there. We're not there quite yet. So
we're over to the majors. We're getting up to the majors.
Yeah. So Lexington.
Or we got one more deal in the 80s here.
Yeah. Lexington. We're not there yet. Sorry. All right. 80s, 26 million, 158 a door over in Grand Prairie. What are you thinking about this deal? This is new debt on this deal.
New debt, 160 a door.
160 a door.
I don't think Grand Prairie's that good of a market to justify 160 a door, but I could be wrong there.
So let's dig in a little bit.
So I think some of those higher prices you're seeing is because of the attractive assumption. So if there's no assumption here, I think we got to do a little digging to see what's going on.
We'll dig in. All right, let's dig into this guy a little bit.
Could be a bunch of 3 bedrooms, maybe, and they're getting a lot of NOI.
Let's pull it up. Higher rents, you thinking?
Yeah.
Just in general to justify the price per door.
Mm-hmm.
All right. So, I mean, average unit size 791. A lot of times people
That's
look at
pretty
not
good.
only price per door, but also look sort of price per square foot as well out there. So let's see. Let's pull this guy up.
So occupancy is high, square footage is above average, and then the proof will be on the unit mix and the rents.
All right. Let's go. All right. Lexington. 164. So they're giving this a B rating on the improvements, C on location, 1983. All right, here we go. So about 75% ones, 25% twos on this one. Rent's about 1164. This one, it looks like there was a Fannie Freddie loan on it, 2021. I'm trying to think what was. It doesn't look like it's a fixed rate, so this might be a floater on there right now. It does have water. It looks like washer and dryer connections in all the units. Let's look at demographics, 50,000. So pretty similar to some of the other ones that we've seen out there. Let me see. Let me try to. All right, here we go. I think I still have my banner up. All right, take that banner off. Sorry about that. All right, so let's just check. All right, so it's in sort of probably the better part of Grand Prairie, right?
Yeah,
It's on the
decent
north
area.
side. Yeah. Once you get downtown Grand Prairie, it's a little bit tougher. And then you're just right off of 30 right there. So let me take off this layer. So you're off of 30. Let me show you where this is in DFW. You're sort of west of Dallas, sort of east of Arlington, right there. So
what's moving the needle on this property? I'm not seeing it.
You're not seeing it?
I mean, it looks nice. It's in a decent neighborhood. It looks nice. I'm just not seeing the separator, the 30,000 per door separation between the other pockets.
Yeah, I'm not sure. I'm not sure on that one. Maybe we'll have to look into it. Maybe they've implemented a bunch of rubs and got some other income stuff on there. Yeah, the other income might be a little bit higher. So, all right, let's see. All right, let's jump over. All right, so now we'll jump in.
I think this is a good. You kind of go deal by deal, and you kind of see what's moving pricing up or down. Ever so much, and you just start looking at all this different stuff like the annual median income, the rubs, the rent, the size of the units. You start putting all this stuff together, and you start seeing, okay, you can kind of pick out what's priced right, what's priced over, and what's going to be a good deal.
Yeah, I mean, I know people are watching out there. What else should we be looking at? Because James just hit the things that we've been hitting, right? So median income, sort of unit mix, agency,
type of debt
financing,
you can get on the
type of
property,
debt, loan assumption, demographics. So definitely drop in the comments or send us an email of what we should be covering, because I want to cover it just as much as anybody else. So that's why we sort of do these live, just to get people's feedback throughout the whole thing. Because usually James and I just do these calls with each other. So
or we just go out, drive around,
take a look at some of these
kind
properties.
of foods in the area.
That's usually, so I think that's the next level, is we're live and we're eating live at some of these, just to figure out the restaurants in that area. So
we're live on the deal, pointing out different stuff.
So all right, Central Park townhomes. So this is 72 unit deal, 11.5, 159 a door. But I believe so this is over in White Settlement, which is sort of west Fort Worth suburb. So let's pull this guy up again. So they're saying 5% going in cap.
Tax adjusted.
Tax adjusted, new agency. So they're saying 70% leverage on new agency. So pretty strong. So let's pull this one up. I mean, I think I pulled this one up early. I did a little bit of research ahead of time. So can you see this unit mix? I can make it bigger. I mean, it's probably 72 units. Average square foot is 1132. Rents are about 1,300. They think you can push rents to about 1,500, and it's all 2 bed, 1 bath, 1.5 bath. So a little bit stronger. no one bedrooms, all townhomes. So it's pretty good sized deal, good unit mix. And they wanted how much? 11 and a half.
160 a door.
Yeah, 160 a door, 11.5 million. So, I mean, that might be a good size deal for someone to take a look at. And then if it sizes to, let's say 11 and a half, let's just say 65%. So you get a $7.5 million loan. You put down 4 or 5 million, or raise 4 or 5 million. It's not bad out there. So,
Yeah, compared to that other one where it was 80% one bedrooms, that'll justify.
unit mix is a little bit better.
Yeah, that extra $200 a month in rent per over 70 units is going to get you a little bit higher price per door.
Yeah, so I mean, it looks like if you look at this pro forma, they have obviously a pop in rents, vacancy is about the same, increased other income by about 80,000. So that's probably the big pop on the revenue side, besides the rents. Pro forma expenses are pretty much the same. I'd have to probably check on taxes, maybe reset taxes a little bit. But yeah, overall, I mean, I think that's pretty standard B deal right there on that one. So that was Central Park townhomes.
You think if somebody bought a deal last year or 2 years ago and the value dropped, you think they're going to get reassessed for lower taxes?
No, taxes don't go down.
Stay flat.
Yeah.
Or only go up. Taxes only go up.
Yeah. So I haven't seen it come down. I mean, I guess the only way that the taxes really come down is if we go back to the beginning, right? If you go in to HCAD or Harris County Appraisal District and you said, hey, I just bought it for this price, then it might get reassessed to that price, right? So
got a couple questions on the live stream.
All right, let's hit them.
Brian Bell asks, are investors looking for a certain spread between rate and cap? I'm guessing interest rate and cap rate. Are they looking for positive leverage or negative leverage?
Go ahead. What do you think?
I think people obviously want a higher cap rate to buy at a higher cap rate than their interest rate for sure. Not all cases work like that. I really just think it's the market appetite. If people are still wanting to buy deals with, let's say even leverage, a 5 cap with a 5% interest rate, and you're thinking, okay, if I can make that deal work and then I hold on and we think cap rates are going to go back down again once interest rates go down, I think that might be some people's thinking, like strike while there's a chance. But I'd say overall, yeah, you'd want a positive leverage deal. What are your thoughts on that?
Yeah, absolutely. I mean, if interest rates are 5.5, pretty much everyone wants to buy on a 6 or higher right now. Most deals are not trading at a 6 right now, except maybe a C deal. Most B deals are, like we've seen, they're probably around 5.5, and then A deals, we're getting to the A deals, but those are probably 4.75, 4.5 to 4.75. So you just have to, what you want to do is buy the deal at 5.5. And that's your interest rate. That's good. But then you have to see an upside in rents at that 5.5 number. So if you buy at a 5.5 cap, you want to see an upside in rents in order to get there. So
we've also seen where somebody, could get a 5.5 cap on a 5.5% interest rate, but they wanted the extra, 4 million in proceeds. So they did a little bit higher interest rate and a little bit higher leverage, thinking that the market's going to go up. Next, we got another question.
Yeah.
How far out do we need to go before going outside of a major market? I guess to be considered a secondary market, is that?
Yeah, secondary markets. I mean, let's just use DFW as an example. We can just, I'll pull up a new screen here. So let's just take Lubbock. Yes, that's definitely secondary, tertiary. I mean, so if you look at DFW and so here's a map. Let's just close this out.
So primary market, DFW.
Yeah. So DFW is a primary market. Even if you go out to, let's say, Denton out here,
Denton's still
that's
in the sphere.
it's in the sphere, but a lot of guys will probably consider that secondary.
Okay.
And then I would say secondary is probably Sherman as well. So Sherman's secondary, Denton's secondary.
What about Prosper, McKinney, Frisco? That wouldn't be considered secondary, right?
No, not anymore. So we're gonna look at a couple deals up in this Prosper McKinney area. I mean, this Prosper or Salina up here, they just announced a Costco right there. So if you got a Costco, you are a primary market. That is the driver. If you don't have a Costco, if you don't have a Costco, then I would consider secondary. We were out here in Tyler. That's considered probably secondary. Everything sort of between Dallas and Austin, sort of Waco, Killeen. This is all secondary in this general area. Usually, I would say major market, you probably at least have to have 1 million or so people in that MSA for a major market. Probably top 20, top 25 MSA. Like Fort Worth, I'm trying to see. Waco is probably $200,000-$300,000, 200 to 300 population, I think, in Waco, something like that. So I mean, that's considered secondary. And then as you get out further,
I'm not seeing any Costco's in Waco.
No Costco in Waco quite yet. All right, so yeah, that's what I'm saying. It's secondary, right? So primary markets have at least one Costco. So that's the bellwether.
That's a good leading indicator.
Yeah, and then as you get out further, so Waco is probably secondary. Abilene, Lubbock, Midland, all this stuff out here, this is probably more tertiary. So you're going to have a little bit more challenging time frame, or getting financing out in those markets. Fannie and Freddie will go out to some of those markets, but they have to see no sort of concentration in employment or industry out there. So
what about demographics and management in the secondary market? Is it a little bit tougher than primary? What are like the 2 or 3 differentiators you think that make a primary better than a secondary?
Well, I mean, primary, you're going to have a lot more choices, right? In DFW, you're going to have, a choice of 10 different management companies. In a secondary market, you might have 1 or 2. And then in terms of staffing, your payroll is going to be cheaper, but you're not going to have as many choices, right? So if your guy quits, it might take you 3 months to backfill that maintenance guy, right? So it's just a little bit harder. Payroll's cheaper in secondary markets, but it's a little bit harder to retain the staff. What we're going to see in these primary markets right now, compared to secondary, is cap rates, right? If cap rates expand in your primaries, they're going to expand in your secondary markets. And so we're going to see a little bit of a slowdown, I think, on the secondary side in terms of transactions right now. So, all right. I think we got a couple more. Let's try to hit these class. We're almost to the big leagues here in terms of Class A. So let's go there. All right, so this deal, this one's out in Denton, secondary market, 325 units. Let's see, this one was, let me back this up. Square 9, 180 a door out there. So you can see secondary market, it's not going to be as high pricing wise. And this one was built in 2009. One thing you're gonna have to just check is the student concentration. So it's whenever there's student universities close by, Fannie's gonna want probably the lower student concentration, the better. Right now, they just don't like the 9-month leases and no parental guarantees. So you're gonna have to check on that one. We were out at this property, a list of townhomes. So, I mean, how big were these units? This was almost all, I think, 2s and 3s out there, or mostly 2s and 3s.
Bedrooms, townhome style, 2-car garage, private neighborhood. I mean, if this was a 200 unit deal, everybody would be all over this one. But it was a nice unit mix, nice privacy.
196.
Occupancy was really good. I thought it was a pretty good deal.
196. All right, April 20th. So if you haven't set up your tour, get out there. All right. So now we're in the big.
You can check on YouTube. We did a video on it.
We did a drone footage of
Yeah, we
that
got some
deal.
drone footage, and it's right by the lake. Nice built-in amenity.
Oh yeah, you don't have to pay for that lake. You don't have to upkeep it. It's pretty nice. All right, Pros Frontier. So this is out in my neck of the woods, sort of North Dallas. 324 units. What's the whisper price on this guy?
240 a door.
240.
77.5 million.
77 and a half. So get the big checkout on this guy. So let's see. I pulled the rents down here on the bottom. So it is about 50-50 on the floor plans, ones and twos. 963 square feet. So bigger unit types here. And then rents are about $1,600. So you're getting up there. So this is in lease up right now. So it was 88% leased, occupied with 77%. So, this property, on these lease up deals, one thing that's nice is Fannie and Freddie do have sort of a stabilized program where before it gets to that 90% occupancy, you can actually go straight into a Fannie Freddie. So if anyone's interested in that, I mean, most of these deals, I would say probably size in that 55 to 60% range though. So, I mean, that's still a pretty good size raise at 77 million. Let's say you're raising 40%, so 30 million bucks on this one to put it down. So, but this one is pretty far up north. Let me see if I can pull it up. So this one's up in Prosper, up in my neck of the woods up here. Let's see.
Yeah, what's going on in Prosper? A lot of development.
A lot of development. So pretty much so if you look at Frisco, there's only really like one little plot of land right here in the middle of Frisco that is called Brinkman Ranch that pretty much they've just started building out right now. And then as you go north, here's Prosper, here's Pros Frontier. So you have 380 that connects to Denton, which is nice. But I mean, the location of this one is across the street from the high school. You got a bunch of single family around it. The only thing so here's Tollway right here. So Tollway is going to be extended. So you're going to be close to Tollway. You're going to be close to Preston. So, I mean, a lot of single family out here. So you're probably not going to have as much apartments in this area compared to some of the areas. Less competition for a little bit. And then
until that new supply comes online.
Till the new supply comes. So, all right. So that was, do you remember how much that one was? 240?
240 a door.
240 a door. All right.
Kind of right on par with the replacement cost that we got from NMHC.
Was that 250 a door? Something like that?
Yeah, 240 to 260 a door was kind of replacement cost right now.
All right.
In the Dallas-Fort Worth suburbs.
So now we're going a little bit. This is a little bit further north in Salina, 71 million, a little bit smaller, 272 units. This one, rents. So I don't know if this is right. They're saying rents are close to 1,900 on this one, bigger units on this one. So on a lot of these, sometimes the rents can be like the market rent, and then they're given a month or 6 months, 4 weeks or 6 weeks free on some of these properties. So that might be a little bit of the challenge on this one. So this one is a little bit, some concessions to get it leased up. And so this one is a little bit more expensive. So you're right at 260 a door on this guy. So similar story as the other one. But as you can see, I mean, these guys are developing these properties out there, leasing them up, and then selling them, moving on to the next project. So
who are the buyers? Who's playing in the big leagues?
Big leagues. So I mean, when people could raise money, a syndicator could take this deal down, right? So
someone called up from AAA trying to go make it big.
Yeah, I mean, this one for sure. Let me see, Levana, Bluewood. Let me see if I can. So I mean, these aren't. I mean, they're not that far apart. Let me see. So yeah, I mean, they're not that far apart. I mean, Levano's up here. It's on the east side of Preston. it's not as, it's still a lot of single family. Like all these houses over here are probably still $600,000-700,000 in this range.
Mhm.
And it's got, a little Collin College out here, community college out there. So I like this location a little bit more over here. Just you're right next to the high school and a lot more single families built out. But this one, I'm guessing, is a little bit larger units and just higher pricing. So the price per unit's a little bit higher out there. So, but yeah, in terms of buyers, I mean, this would be institutional money all day, right? So it's just, I don't know how deep that pool is right now. So we'll just have to see, because most of the people are probably going to do like, life insurance or Fannie Freddie on this large of a deal.
Are they still pencils down? I think they were pencils down at NMHC, right?
Yeah, I mean, I think they're coming back more so in like the pref equity space, more so than the common equity space. So we'll have to see sort of where those deals end up trading, track those. All right. So now we're wrapping up with the big dog here. 12 units over in McKinney, so north side of Dallas. 4.3 million, 358 a door. Obviously, this is a unique product. It's all 3 bedrooms, 1,800 square feet. It's really more like single family out there. I think if you look at this picture, they're sort of attached, I think, by the garage or something. So pretty unique offering. Rents about $2,200 out there. Any thoughts on this one?
I think that's going to be not an institutional buyer. I think that's
This is gonna be a local guy that was gonna buy this.
someone local. But
Yeah.
I think McKinney is just an amazing market. Is all McKinney, Frisco, all that area is super nice. Everything that I've seen in the area, it's all new. We'll see what happens when Disney comes to town, but is that still going on?
No, Universal.
Universal. Yeah.
No. Everybody would be happy with Disney. I mean, Universal. Everyone's not sure exactly what they're going to get with Universal.
So
But
I'm thinking Disney World and then Universal. Though, kind of have them all in the same bucket.
yeah. We'll have to do a drive-by. Let's see, 1201. Yeah, 1201. All right, so.
Brand new construction in McKinney.
So
pretty
we've
solid.
got it. If you've made it this far, we'll definitely give you a reference here. So and James, you'll have to come up to this neck of the woods. We'll do a what's the deal live out here. Hutchins Barbecue.
I'm gonna be hunting for a new spot to live with some of those concessions.
Look at this. All right, Hutchins Barbecue. Look at that reviews. You see the number of Google
4.7?
4.7, 5,000 reviews.
Wow.
So walking distance to Hutchins. Was that in the OM? Let's see if it's in the OM. I don't know.
It should be.
It might have been in the OM, but so maybe we'll come out here and drive around a little bit.
What's the deal live?
What's the deal live out there?
Review Hutchins
in McKinney.
Barbecue.
Hit Hutchins Barbecue. That was the original one, so they have one there and they have one in Frisco, so good spot to go. All right, I think that was the last one. Appreciate everyone jumping on. I think I appreciate James putting this deal tracker together. What we'll do is, if you missed any of this or if you want, just comment below and we'll send you this PDF. We'll just PDF this whole deck and send it over to you via email. So comment below, like the video, share it with a bunch of your friends who are interested in multifamily, and they're like, I don't understand what this is all about. I learned a lot. I probably got 2 or 3 deals that we need to go take a look at. And so before we jump off, if anyone has any questions, put it in the chat, but we'll be back next Tuesday. What's on the docket for next Tuesday, James? Do you remember what we're gonna be covering?
Have we gotten that far yet?
Oh, okay. I think next Tuesday, I think we're doing underwriting. So we always get all these questions on underwriting, and people are like, I don't get it. So we'll put together. I don't know if we're gonna go this long on underwriting, but
I don't know if we can go an hour and a half on underwriting.
30 to 45 minutes on underwriting next Tuesday. We'll put the link in the comments and everything. So
yeah, we can go line by line. on a T12 and just go over what to look for, kind of
And
high
maybe
level.
some we'll go. I like this format of sort of A, B, and C, like, or sorry, CBA,
Yeah.
because each one of these is going to have like different things that we'll pull out. So maybe we'll pull down the T12 on some of these deals and then just go through them and then just sort of show how we're underwriting it. So I appreciate it, Enzo. Thanks for watching, and we'll see you guys next Tuesday.
All right. Have a
All
great
right,
day.
all right. See you guys.